With credit concerns beginning to surface in the financial markets, our guest today says investors may want to focus on quality and not so much about chasing yield. Joining us now with more, Anthony Mbezi, VP and Director for High Yield Portfolio Management with TD Asset Management. Anthony, welcome back to the program.
Thanks for having me.
This has been an interesting space. Obviously, some concerns on Wall Street bubbling up last week. How are things generally looking out there right now?
Well, in the high yield markets, I think generally things are looking okay. We've had a good year to date. The market is resilient, as we've seen the way it's performed during periods of volatility, like we saw in early April with the sell-off based on the U.S. tariff announcements. And right now, if you look at valuations, spreads are about 304 basis points, which is okay. It's where they are. That's the average year to date. But if we look at a more broader historical perspective, maybe over 25, 30 years, where averages are about 520, it might be looking a little rich, you would think, given that it's closer to the lows of 250 than the average of 520. But the reason the market is, or at least investors are comfortable with this, is one, there's very strong demand for yield right now. So investors are looking at the high yield market and saying an average yield of 6.8% looks attractive. Year to date, the average is 7.3, but currently we're getting 6.8%. The corporate fundamentals are also very supportive in that earnings have been good second quarter. We're entering Q3 earnings season, and expectations are that things could still continue the way they are. Balance sheets are in good shape. Companies have been quite disciplined. They've learned their lesson after COVID, the pandemic, and are quite disciplined about how much debt they keep on their balance sheets. The economy is still performing well. Default rates are low. And I'll also say that if you look at the overall quality of the credit market, or at least the high yield market, 54% of it is BB rated. That's the highest. And about a third is first lien debt, which is more than double where it was pre-COVID. So you factor all these things in, maybe investors are thinking about what the Fed and how many rate cuts we get going forward. Locking in yields at these levels right now does seem attractive, and that's kind of why, or where we are right now.
All right, so that's what's working in favor of the space. Obviously, there's always potential risks out there. Tell me what you're focused on.
Now, how did I know you were going to ask me that question about risks or concerns? But it's an important question. And yes, there are risks that we're looking at. In the credit space, I'm looking at the ratio of upgrades to downgrades. For the last 19 months, there have been more upgrades, credit rating upgrades, than there have been downgrades. But as of September, the September data, over a one-year period, this ratio is now inverted, and we're seeing more downgrades than there are upgrades. It may mean nothing right now, but if this trend continues or it gets worse, it would be an indication of where the direction of we're seeing for credit quality or just credit fundamentals in general. So that's one for the credit market. The U.S. consumer is always one that we're keeping our eyes on. Maybe in the data we don't see things, and just given how important the U.S. consumer is to the economy, it's one that you want to look for stresses or signals that the consumer may be challenged. One data point that I saw was that the price of a new vehicle in the U.S. is now over $50,000. That's very expensive. And I'm also reading that a quarter of trade-in vehicles to buy new cars have negative equity, which means...
So you roll into the lot thinking, okay, a new car is pricey, but at least I can trade in my old car, but you're underwater on the old car?
By about $7,000 on average. Wow. That's another record. So consumers are pretty challenged right now in affordability on cars, and they're even more likely to take out 7-year loans just to afford the monthly payments, which makes it even more challenging because it increases the cost of owning a vehicle, and a long-term loan on a highly depreciating asset is never a good idea. And I would say the last thing I would really highlight is how much complacency is there in the market right now? Are investors really looking at or really worried about anything at all? Just given how much this market continues to rebound. We saw in September what would normally be non-high profile bankruptcies, Tricolor and First Brands, sent ripples through the markets. These companies now, as we're learning, there could be some fraud allegations whereby they issued debt, multiple loans under the same collateral. One was even lending to consumers without any documentation or driver's licenses. They actually give subprime loans to car buyers. So this sent shockwaves through the securitization market, private capital. It's telling how are due diligence standards deteriorating or not. And now we just heard about 2 regional banks last week, which again speaks of, is there systemic risk out there? We're not sure, but I think right now probably not. These are isolated events. They're not big in terms of impact, and these regional banks Even the loan write-offs that they took are not that meaningful. But again, it begs the question, is there anything else out there that we're not really paying attention to?
Something definitely keep an eye on. What about opportunity out there? So you gave us what was working in favor, you gave us some of the risks you're looking at. What about the opportunities in the space?
Yeah, there are opportunities, and we're finding them, but it's getting more challenging. So you really have to do your work and make sure you know what you're buying, because in this market, given where valuations are, there's less room for error. And we're finding opportunities in the U.S. market, Canadian high yield, even the European market. There's opportunity in names that look attractive to us. Within the capital structure of companies, we're finding both secured first lien debt, unsecured, even subordinated, and convertible bonds. So there are things out there that make sense to us on a risk-adjusted basis. We're also looking, for example, if we look at high-yield bonds versus loans, about a year ago, I would say loans offered sufficient compensation for the risk. Right now, that compensation has decreased, so most of the opportunities we're looking or finding actually are in the high-yield space. So yeah, within sectors, I mean, we look at all the sectors, but in particular, opportunities in healthcare, media, telecom, financials, even in the basic industry, we're finding opportunities. So there are out there. It's just you really have to do your homework, and security selection is of paramount importance right now. It really matters more than ever, just given where we are in the credit cycle.